Hey everyone! Today I'm answering one of the most frequently asked questions that literally keeps new investors awake at night. ETF or index fund? Which one is better for building long-term wealth? This confusion isn't just yours. Thousands of people ask this exact question every single day across Reddit, YouTube, and financial forums. Both serve the same fundamental purpose, but through completely different paths. Today I'll explain the real differences between these two investment vehicles, when to choose which one, and most importantly, which one is actually more profitable with real-world examples and hard data. By the end of this comprehensive video, you'll have a crystal clear decision based on your specific financial situation. Let's dive deep into this topic. Think of an index fund like this. There's a massive basket. Inside that basket are all the companies in the S&P 500, Apple, Microsoft, Amazon, Google, Tesla, all of them together. You put money into this basket, and it automatically invests in all these companies proportionally based on their market capitalization. There's no human fund manager involved making emotional decisions, just a sophisticated computer program doing the work based on mathematical rules. Real example, Vanguard 500 Index Fund ticker VFIEX. If you had invested $1,000 back in 2020, it would be worth approximately $1,800. Today, that's an impressive 80% gain. In just 4 years, advantages of index funds, low expense ratios, typically 0.03 to 0.10% annually, which means you keep more of your returns over time. Automatic diversification. One single move invests in hundreds of companies across different sectors like technology, healthcare, finance, and consumer goods. Long-term stability. Tracks market averages without the drama of individual stock picking. Perfect for retirement accounts like 401k plans where you want simplicity. Set and forget mentality that prevents emotional trading decisions. Disadvantages of index funds. You can only buy or sell once per day. After market close at exactly 4 p.m. Eastern Time. High minimum investment amounts, usually $1,000 or more to start, which can be a barrier for beginners. No real-time pricing. You learn the actual value at end of day. Less flexibility if you need to react quickly to market changes or breaking news. Important note, index funds are actually a specific type of mutual fund, designed to track market indices. Think of an ETF or exchange-traded fund as the exact same basket. But now you can buy and sell it like a stock throughout the entire trading day. You can buy at the moment the market opens at 9:30 a.m. or sell it during your lunch break if you see it drop significantly. This flexibility is absolutely game-changing for many investors who want more control. Real-world example. SPY ETF tracks the S&P 500 just like VFIEX, but trades like a stock. If you see it drop to percent during the day due to breaking news, you can buy immediately and potentially catch the dip. You absolutely cannot do that with an index fund because you're locked into end-of-day pricing. Popular ETFs you should know. VOO, Vanguard S&P 500 ETF, expense ratio 0.03%. Tracks the exact same index as VFIEX but with more flexibility. QQQ, Invesco Nasdaq 100 ETF, tech-focused, includes Apple, Microsoft, Google, Amazon, Tesla. VTI, Vanguard Total Stock Market ETF, covers the entire U.S. stock market including small and mid-cap companies. SPY, SPDR S&P 500 ETF, the oldest and most liquid ETF in the world with massive daily trading volume. Advantages of ETFs, instant trading during market hours from 9:30 a.m. to 4 p.m. Eastern Time. Ultra-low minimum investment. You can buy just one share or even fractional shares on most platforms. More tax efficient, especially in taxable brokerage accounts. Complete transparency. You see real-time prices updating every second. Lower expense. Ratios on average compared to actively managed funds. Better for mobile app investing on platforms like Robinhood, Webull, and M1 Finance. Disadvantages of ETFs. Bid-ask spread costs. Small difference between buy and sell prices that can add up over time. Intraday price volatility can create psychological stress and tempt you to make poor decisions. Psychologically encourages more frequent trading, which statistically hurts long-term returns. Requires more discipline to avoid the temptation of overtrading based on daily market movements. Let's talk hard numbers and real comparisons. Cost analysis deep dive. Index fund VFIEX is 0.04% annual expense ratio. ETF. VOO 0.03% annual expense ratio on a $10,000 investment. The annual difference is literally just $1, so cost-wise, they're virtually identical. However, ETFs often have slightly lower expense ratios across the board. Tax efficiency. This is where ETFs absolutely dominate. ETFs win here by a massive margin. Why? Because of the brilliant in-kind redemption mechanism. You pay significantly less in capital gains taxes. Here's how it works. When investors want to sell ETF shares, the fund company can give them actual stocks instead of cash, which eliminates taxable events. Real example, in 2022 when the market dropped dramatically, most index funds were forced to make taxable distributions to shareholders. But ETFs avoided this completely. This saved ETF investors thousands of dollars in taxes. Liquidity. Comparison. Index fund liquidity, once per day at exactly 4:00 p.m. Eastern Time. You submit your order and wait until market close to know your execution price. ETF liquidity. Anytime during market hours with real-time pricing and instant execution. You know exactly what you're paying before you complete the transaction. Psychological factor. This is absolutely crucial. Index funds naturally support the set and forget mentality because you cannot constantly check prices and make impulsive decisions during market hours. ETFs, since you can see prices constantly updating throughout the day, might tempt you to trade more frequently, which studies show statistically hurts long-term returns. The average investor significantly underperforms the market due to poor timing decisions. Which should you choose for your specific situation? Choose index funds if you want to completely set it and forget it without any temptation to trade frequently. You want to make regular automatic investments every paycheck without thinking about it. You're investing large amounts, $5,000 or more at once. You have tax-advantaged accounts like 401k or IRA, where tax efficiency doesn't matter as much. You're prone to emotional investing decisions and need built-in guardrails. Choose ETFs if you're starting with small amounts under $1,000 and want to get started immediately. You're investing through modern mobile apps like Robinhood, Webull, or M1 Finance that focus on ETF trading. Tax efficiency is critically important to you in taxable brokerage accounts. You want maximum flexibility and control over your investment timing. You're disciplined enough to avoid the temptation of overtrading. You want access to specialized sectors or international markets. My personal recommendation based on years of experience, if you're just starting out your investment journey, go with ETFs. Why? They're more flexible, often have lower costs, and better for the learning process. You can start with tiny amounts and scale up over time. However, if you're maxing out retirement accounts and want simplicity, index funds work perfectly. Find out a pro tip that most people don't realize. You can use both simultaneously. Keep index funds in your 401k for automatic simplicity, and use ETFs in your taxable brokerage account for tax efficiency. This hybrid approach gives you the absolute best of both worlds. Concrete strategies for different investor profiles. 22-year-old recent graduate with $1,000 budget, 70% VTI total stock market ETF for broad US exposure, 20% VX US international ETF for global diversification, 10% BND bond ETF for stability. This aggressive allocation makes sense with decades to recover from downturns. 35-year-old mid-career professional with $50,000 budget, VTSAX total stock market index fund for core holdings with automatic investing, $2,000 monthly automatic investment to remove emotion from the equation. This set and forget approach is perfect for busy professionals who don't want to think about investing constantly. 50-year-old preparing for retirement, 50% index funds for stability and lower volatility, 30% ETFs for flexibility and tax efficiency, 20% bonds for capital preservation as retirement approaches. This balanced approach reduces overall portfolio risk. Biggest and most costly mistakes people make: constant trading addiction. ETF's easy trading feature psychologically tempts you to become a day trader checking prices every hour. Resist this destructive urge at all costs. Bad market timing, selling when the market drops in panic, buying when it rises due to fear of missing out. Always do the opposite of your emotions. Over-diversification madness, buying 20 or 30 different ETFs thinking more equals better protection. Ignoring expense ratios completely. There's a massive difference between 0.03% and 0.75% compounded over decades. Warren Buffett's famous will for his wife specifies 90% S&P 500 ETF, 10% government bonds. If it's good enough for one of history's greatest investors, it's probably good enough for regular people. Simple but incredibly effective over long time periods. Bottom line, after analyzing everything, the ETF versus index fund debate is exactly like choosing between Nike versus Adidas running shoes. Both will absolutely get you to your financial destination. What matters infinitely more is actually taking action and starting your investment journey today. Perfect is the enemy of good, and either choice is dramatically better than keeping money in savings accounts earning practically nothing. What you should do starting right now: first, honestly determine your available budget and risk tolerance. Second, carefully assess your investment personality and tendency toward emotional decisions. Third, pick one option based on your analysis and commit to starting immediately. Fourth, stay consistently invested regardless of market volatility and scary news headlines. Share in comments which path you're choosing. If this comprehensive video helped clarify the confusion, smash that like button and subscribe for more detailed financial content. Next video, dollar cost averaging strategy with mathematical examples. Don't miss it. Remember, whether ETF or index fund, the most important thing is actively investing in your future. Both can take you to complete financial freedom with discipline and consistency. Asterisk important disclaimer: this video is for educational purposes only and does not constitute financial or investment advice. Past performance does not guarantee future results. Please conduct your own research and consider consulting with a qualified financial advisor before making investment decisions. All investments carry risk and you may lose money.